Hello and welcome. This is BloombergQuint. Over the last 5 sessions, we've seen declines in the BSE Midcap Index as well as the Nifty 500. And we've seen more of a correction when it comes to the broader markets as compared to the benchmark indices. So we're here to take stock of the markets right now and where we're headed. And for that, we are in conversation with Mayuresh Joshi, Fund Manager with Angel Broking. Mayuresh, thanks for joining us. Mayuresh, I'm going to start off with your expectations on the direction of the benchmark specifically. You know, we've seen a little bit of a correction over the past couple of days, a healthy correction. Is there more coming, or are these good levels to buy?
So afternoon, Agam. Thanks for having me. First of all, I think the markets had run up significantly, and if you just map the market movement in terms of the earnings that have come through so far, I think the markets are working on the premise of an earnings recovery happening by the second half of this fiscal. So largely, I think we are trying to front load the kind of earnings expectations that we have, and again, largely the street is of the belief that a 15-16 earnings growth is not ruled out for this fiscal, and again. For the next as well. But largely, again, I think we've reported a missed set of numbers for Q4 so far. And again, I think the expectations with the GST coming through, I think it's going to be a little disruptive, at least for a quarter or two, as the supply chain management, as the inventory levels probably start getting normalized and probably get used to the system on GST. So again, I think not expecting a great fall or a great correction for the markets from the current level. I think what you're probably seeing at this point of time is a healthy sign for the markets, in my opinion. So any correction into this market, I think qualitative names is something that can be looked at by long-term investors.
Okay, so my next question is going to be a little more general, but it's got to do with large caps as against mid caps, and a lot of people in the markets are of the opinion that the mid caps had run up substantially more, and hence they were overvalued as compared to large caps. Where do you stand in this picture if I were to compare these two segments in the market, so to speak?
So largely, again, one has to really understand that large caps will probably have a larger cushion in terms of market fall, which is far greater than what the market expects at this point of time. So if there is an accentuated market fall over the next few weeks for whatever reasons, global reasons, my own sense is that large caps probably provide you that much cushion of safety. The mid caps have probably run up ahead of their earnings estimates, at least for a large part of the mid cap universe. So the correction there can be quite lethal in terms of a market fall. So in that sense, again, I think I'll be more skewed towards large caps at this point of time. But again, I think you can't rule out mid and small caps. So any qualitative declines into good names within this universe, I think they can become good buying opportunities. But again, I think investors need to understand to probably enter the markets in a staggered way, because even if the market's correct, they might just consolidate at lower levels before they make their up move.
Another question for the markets currently is, of course, once again, when it comes to the banking sector, the private sector banks are more preferred as compared to PSUs. But some were also of the opinion that the PSUs were so beaten down that there could have been a little bit of a closing in of gap between the PSU banks and private sectors. Once again, where do you stand in this case?
So largely, again, I think the bias has been towards private sector banks and that to retail private sector. But over the last few quarters, as the AQR provisioning started happening in the fourth quarter of FY16, a lot of pain has got recognized by corporate-facing balance sheets. And with that respect, I think the credit costs and the kind of provisioning that we saw for the last 4 quarters, including the watch lists that were declared and slowly recognized, I think that has taken a toll in terms of how the return ratios for these corporate-facing banks have panned out. When it comes to the public sector universe, I think largely you're trying to phase out two aspects, the larger ones and the mid and the small cap ones. The mid and the small cap ones still have a lot of pain in terms of asset quality pressures stabilizing on their balance sheets, and capital adequacy becomes a huge amount of a problem for them. So still capital infused, the balance sheet expansion probably still remains constrained. And with that respect, again, I think even though they're trading at mouth-watering levels in terms of price to book valuations, the larger ones is something that can still offer some amount of comfort in this universe. Having said that, I think with the kind of asset quality pressures that are still expected to come through, and with the ordinance that is expected to get passed in terms of resolution of bad assets, it is quite possible that whatever pool that we've got in terms of recognition, there might be higher provisioning happening because of the haircuts that one might need to take on that, and that again might have some amount of toll at least for the first half, if that recognition starts taking place. So largely, again, I think it's more a long-drawn story, but I think the worst will probably get over in the next 2 to 3 quarters, in my opinion. I think the next few months will give good buying opportunities in large cap PSUs names, and again, I think large cap private is something that I've always liked. So I think whether it's be corporate or the retail side, I think these banks can be looked at in a staggered manner over the next few months.
Mayuresh, again, when it comes to opportunities in the market, are there themes out there which still need to catch up, which may be fundamentally strong, but they have not run up substantially? Are there opportunities out there in the markets yet?
Again, yes, I would say that markets always give you opportunities across levels. So again, at this point of time, if you largely assume that the government capex, as it is getting front-loaded for this fiscal as well, and expected to be done so, I think largely that would drive private capex by the end of this fiscal. So by Q4 FY18, I think the private capex should start reviving meaningfully, and that will probably give some amount of respite for a lot of these industrial consumable themes. So I think a lot of companies which are operating within industrial consumable space is something that I remain very, very optimistic about. Secondly, I think even with the GST imposition and the kind of rates that have come through, and even if you assume that for a few sectors like cement, for example, for building materials, for electricals, I think even if the rate has gone up, I think you're bound to assume that it will be a fast through happening on that front. And with that respect, again, I think these companies should be in a very advantageous position as the volume activity starts building up on their balance sheets. So as meaningful demand starts coming back, I think all these sectors also lay in a very sweet spot. So I think consumables as a space, whether that be selective FMCG, consumer staples, is something I remain optimistic about. And autos, I think autos is something where the demand trajectory is extremely stable at this point of time. As volumes start growing and improving exponentially, again the leverage will be played out very, very positively on their balance sheets. Input cost inflation, the cess that has got announced on petrol vehicles of 1%, diesel of 3%. I think largely with the ticket sizes that we're dealing with, I think it does not make a huge difference in terms of buying preferences. So I think these sectors is something that I'll be skewed with from a medium to long term.
Finally, Mayuresh, we're looking at the current government finishing 3 years. Anything on the wish list with respect to reforms that could change the game for the markets?
So largely, again, I think two main aspects, at least for the first half of this fiscal. I think GST implementation is going to be extremely critical and crucial. And yes, as I said earlier, I think there will be some amount of hiccups as it is introduced in terms of the inventory management, in terms of the supply chain management, the logistics involved thereof, and again the compliances that a lot of MSMEs and SMEs need to follow across the value chain. I think implementation thereof is going to be extremely critical in terms of the progress of GST and its strong effective execution. Second, I think on the NP resolutions that we've talked and spoken about, I think RBI has already initiated an oversight committee that probably will look into this whole issue. And as these issues get resolved over the next few months, and if they're going to do that in a very systematic manner, I think the bad loan issue probably should start getting resolved over the next few quarters, which will give a huge respite to the banking industry as a whole. And again, I think the whole impetus of credit growth reviving and capex reviving with reforms coming from these two fronts will largely lead to the private consumption improving, and that will probably lead to a recovery. So I would look at reforms from a government perspective.
Mayuresh Joshi, it was a pleasure speaking with you. Thank you very much for your time.
Pleasure.